Right, well, staying with that strong retails report today, analysts questioning if the market's reflecting the environment and whether we could be seeing late cycle optimism. Joining us with more is Marci McGregor, Merrill and Bank of America private head of CIO portfolio strategy. Thank you for joining me, Marci. So as we look at what we've seen here, some of the wind coming out of the sails for investors as it is sinking in that the Fed is going to have to do more and possibly for longer here. I mean, what were the biggest takeaways for you here into how this does position the Fed and how markets are reacting to it?
Yeah, the Fed still has work to do. I would say they are making progress in their battle against inflation. Leading indicators of inflation are still telling us inflation's falling, but we have seen some data, specifically in the labor market and consumer today, that might be telling us the economy is reaccelerating. No one month makes a trend, but I think the Fed's going to be watching this closely. I think you get a couple more rate hikes from the Fed, and then they spend the bulk of this year sitting tight, watching data, inflation, the labor market, the consumer, to see how much the economy is slowing. But the Fed has more work to do.
So then realistically, where do you think this puts the Fed's terminal rate right now?
Yeah, so I think they wind up pausing in the spring around 5.25%. And like I said, I think they're going to hold policy tight for some time. Our base case is you don't get the first Fed rate cut until early next year. But I think by the end of this calendar year, because the economy will likely be slowing, if not in a mild recession, you're going to have a Fed that starts sounding a lot more dovish, a market really kind of wondering about rate cuts. But I still think that's much further out in the year.
So then as we look at some of these indicators here about what we can expect in terms of a recession, if you look at the yield curve inversion, if you look at the VIX, still under 20 at the moment. I mean, what does this mean for then recession expectations and what the Fed is going to need to have to do to get to that 2% inflation target?
Yeah, this is a really interesting economic environment because I do think risks are still skewed to the downside. If you look at there's huge segments of the economy, like the housing market, manufacturing, that are indicating we're in a recession. Leading economic indicators have been on a downturn for almost a year now. So all of these are pointing to a recession. But on the other hand, you still have a red hot labor market, and that's keeping the consumer on solid ground. We have seen in our internal Bank of America credit and debit card data exactly what the retail sales numbers today told us, that consumer spending accelerated in the new year. But I think the most interesting takeaway of our internal data is that deposit balances, so checking and savings balances, according to our Bank of America Institute, are still on average higher than they were in 2019 across all income groups. So you have a consumer that built up quite a cushion over COVID in terms of savings. They're chipping away at it, but I think they still have a runway that probably takes them to the summer before they get back to those 2019 levels. So as long as the labor market continues to support the consumer has that cushion, I think we're going to get mixed messages on this economy. And that's what's keeping the economy so resilient and giving the Fed a run for their money in terms of slowing down growth.
So then as an investor, how do you position yourself for a Fed-induced recession versus, say, your typical recession that is accompanied with very high unemployment?
Yeah, so I would say in terms of an economic recession, our view is that it would be a mild, more like a reset versus a systemic recession. Where I would be watching a little closer, and I don't think the market has totally dialed into this yet, is the earnings front. I would argue that consensus EPS estimates for this year are just still too optimistic. Now, I'll acknowledge they've been cut pretty significantly year to date, only a month and a half into this year, but there's still, consensus is still looking for 1% EPS growth. Our house view is for a 9% slowdown. I think corporate earnings peaked last year. The good news about that is I think 2023 brings us a brand new profit cycle, but I still think in the coming months, there's going to be some volatility and some noise as earnings expectations are reset. So that's what I'm watching closely now, because I do think the consumer is going to keep this recession to be milder than maybe some are anticipating.
So then there could be still more pressure ahead for equities then. Is this the time to perhaps have more cash on the side, or is this the time to go into bonds? Or where do you recommend people how should they be viewing this when they're trying to position themselves in this sort of environment?
Yeah, it's a great question. When we think about how we entered this year in terms of positioning, it was still a bit defensive, a bit cautious. Now, we've seen some serious rotations in the market so far this year. And I think that's really been driven by sentiment that's improving and driven by positioning. Now, I do think it's a little disconnected from the macro reality. So I see this rotation as losing a little bit of momentum. I can see some choppiness, frankly, a bit of a grind for markets in the months ahead. So we're entering the year a bit cautious. Like I said, we're neutral equities, neutral bonds in a diversified portfolio, and tilting up in quality. I think it's a time to be a bit boring. But I think it's important to have your shopping list ready because we know markets like to look ahead. So while I like high quality, large cap investments right now on the fixed income side, I have a preference for treasuries over credit. I do think that environment can change in the coming months.
And anything in particular you're steering clear of right now?
Yeah, so on the equity side, I don't like some of the high flyers, of the COVID time. So I still think communication services as a sector, even though it was the worst performing sector of 2022 by a huge margin, I still think that those stocks can come under pressure in this new year. I would also steer clear for now of some of the consumer discretionary names. I would avoid that right now as well. On the fixed income side, we're underweight high yield. I don't think you're compensated for the risk right now in a high yield market where spreads are not reflecting, again, I think the very real risk of a recession as we get through the balance of this calendar year.
I do thank you for joining me this morning. Lots of great insights there. Marci McGregor there, Merrill and Bank of America Private Bank Head of CIO Portfolio Strategy. Thanks so much.